Hello and welcome back to another week of your Mortgage Market Movers Weekly, where we are detailing everything going on in the macroeconomy to help you make better home buying decisions. This week's 30-year fix is sitting at a 6.09, which is up slightly from last week's 6.06. But rates have really started to come down there, right? So it was just a few weeks ago we were talking about the 6.10s, right? So this week we have the FOMC meeting, and it's likely going to be a pause, but that is not the main event. The main event is not the decision about the cut, but it's actually going to be the press conference that happens where Jerome Powell gives his spiel. That's always a time of high volatility, and where we figure out where the Fed is heading and what they're thinking. So we're going to get into all that when we get into the full segment. So let's get on into it. So we are looking at the U.S. 10-year, which is, of course, what we use as a proxy for the mortgage interest rates. So new developments with the U.S. 10-year, we can see right here, this was Tuesday, January 20th. It broke up out of this kind of zone that we had been in since, let's see, really about the beginning of September. So, yeah, beginning of September of 25 all the way to mid-January of 26. The 10-year had been in the zone where it broke down, came back up, broke down, came back up, and it popped up out of this. So really, it's kind of a threat for interest rates as far as coming down if the 10-year stays elevated. Now, part of this, I want to say, is more than likely coming from what I believe to be some of the treasury sell-offs from other countries. I believe Europe said that they were selling off some treasuries. So, anytime that there's big selling pressure in the bond market, that's going to shoot the 10-year yield up, of course, because yields and the actual bonds are inversely related, of course. Now, this might not necessarily be reflected in the rates as of now, and that's because there's a spread between what investors want to get for their investment, which is mortgage-backed securities, versus the actual 10-year yield. This 10-year yield is just really, it's a proxy, but it is not exact for mortgage interest rates, but it is what we use, right, to see where the rates are heading. So this is one thing to keep in mind, just, watching this 10-year yield and seeing if we can get back in this zone and down below, right? This is where if we can get below this 4% right here and really stay below that, I think that's, going to be a good spot for having the interest rates come down a good bit, to drive that demand back into the market. All right, let's take a look at the calendar. So this week, the main event is the FOMC meeting, and everybody knows, right, if you pay attention to the probabilities, that there is a 96.1% chance of a pause. I mean, basically that's a 99.999% chance. Are the Fed's going to cut rates? It's really looking incredibly unlikely. So that's not what we're looking for. We are looking for this press conference at 2:30. The decision is at 2. Press conference is at 2:30, Wednesday, January 28th. And this press conference, that's going to be the main event. That is where Jerome Powell, chair of the Fed, is going to discuss the Fed, monetary policy moving forward, what they've been thinking, and the state of the economy. There's always a Q&A at the end, and that's definitely a zone where some volatility can spike up. So all we can do is cross our fingers that it is good for interest rates and, tune in at 2:30. So let's see, anything else that is important for us? I mean, that's going to be the main event. We do have unemployment claims on Thursday, so always good to see labor data. And then we have PPI, so this is inflation from the producer side of things. It's going to be Friday, January 30th, okay? Like I said, 6.09, slightly up from 6.06. And even though that 10-year yield is climbing, one, this is an average, right? Whenever we talk about the 30-year fix, this is always going to be an average on, I want to say it's applications. It says it down here somewhere. Yeah, weekly mortgage rate is now based on applications submitted to Freddie Mac, right? So I don't even, that probably could be withdrawn applications too. I would imagine that doesn't mean total closings. So this number is always based on applications sent to Freddie Mac, and that's one thing to keep in mind. So it might not be super representative of what's actually happening, in your local regions. And it depends on which lender you use too, of course. But also, like I said, the spread, some lenders are willing to make a little bit less money for the business, so they have their spread is not as tight. Or no, sorry, their spread is a little tighter. Anyway, so one potential rate cut, really for two in 26. So we're looking at right now it's priced in halfway through the year, and then at the end of the year, looking for that second rate cut. And then 2027 is really holding steady. But that's a ways away. So we will see. Rate cuts do not always mean lower 10-year yield. I've been saying that we need to keep an eye on inflation. The inflation story is probably going to be what's the most important for the yield moving forward, and consequently what is important for mortgage interest rates. So that's what we have for you this week. If anyone has any questions, comments, concerns, feel free to reach out to us at www.mortgagesbylinda.com or give us a call at 877-TEAM-MBL. All right, everyone. Have a great week. Bye.